Screen is visible
Yes, sir.
Visible, sir.
and my audio is clear, right?
Yes, sir, clear.
Okay, perfect. Um, okay, so I welcome you all in our training program of Basics of Options, which is our chapter 8 of this whole series of Investment Pro. Before starting with the session, I would like to introduce myself first. I am Mukul Todwal and I will be your instructor for the day. Starting and talking about your basic key takeaways from this session, we will be talking more about basics of options trading. In our previous session, we talked about futures, and options is another part of derivatives market, and almost there is a majority of similarity between both the things, but then also they are very different from each other. The topic is again a little bit complex, so we are trying that you get it in the most easiest way, and for that I would request your participation in today's session. So here we are, starting straight away with what actually options is. So as you all can see on the screen, options are a contract that gives the owner the right but not the obligation to buy or sell an asset. If I have purchased an options contract of any stock or Nifty, Bank Nifty or anything, I have the right to buy or sell that particular stock, but it is not obligatory for me to honor this. Okay, so what do I mean by this? uh, Options are nothing else but a right to buy and sell the underlying asset at a pre-decided date and a pre-decided price. Options are very much similar to insurance, and basically there are two types of options. First one is call option and second one is put option. If we'll talk about call option, what actually a call option is, it is nothing but your right to buy. If you believe that yes, in upcoming days the market might go up or your particular stock might go up, and you are bullish about that stock, then you buy a call option. A call option is nothing but an agreement that gives you the right to buy a stock, bond, commodity, currency, or any other instrument at a specified price within a specific time period. When do you actually take a call option? You take a call option only when you believe that yes, your stock, your commodity, or your instrument is going to rise. You have a bullish overview about that particular thing. Then you go and buy the call options. The same way, there is another option, that is put option. It gives you a right to sell. So if you believe that a particular stock or a particular index can go down in upcoming few months or in upcoming few weeks, then you buy a put option. It is nothing but you are short selling that particular stock. So it is an agreement that gives you a right to sell the stock, bond, commodity, or any other instrument at a specified price within a specific time period. What can be the specific time period? We have already discussed this in futures trading. It is 3 months. There are 3 months basically. The first one is near month, the second one is next month, and the third one is far month. So this is similar thing. When do you purchase a put option? It is when you believe that a particular stock might go down and you have a bearish overview about that particular script. So before diving deep into important terminologies, I would like to like give you a very good example of what actually options are. so that you understand that particular thing with a very good example. Okay, so let's suppose we all are looking for a house in any particular place, and the current market price, say like we finalized a house, and we have like whenever we go or to buy or visit sites. Okay, so we don't carry our whole amount with us. Okay, so what we do is, say suppose the current market price of a particular house is say 50 lakhs. Okay, and you and your builder agree to this point. Okay, so it is not possible for you to give 50 lakhs at the very same time. So what you did is, you gave him a particular token money. Say you gave him 50,000 rupees as a token that yes, I will buy this particular house at 50 lakh rupees in upcoming few time. Okay, you please don't sell it off to someone else. I'm giving you the token money for the same. Okay, so what happens after 1 month is, there is some plan of government to, let's suppose, make an airport around that particular area only where we have given the token money of house. Okay, so obviously if any very good infrastructure development is going on, your prices will hike up. And suppose now the prices go up to 65,000 rupees, sorry, 65 lakh rupees. Now like, isn't it your benefit that yes, I have made a deal of 50 lakh rupees only, but now my current value of my investment on that house is 65 lakh rupees, straight away 15 lakh rupees profit, and you have full right over that particular home now, because you have given the token money, and obviously you would have done some paperwork as well. So this you have a very good time now, you have gained a very decent return from your investment. But now at the same time, let's assume that in a situation 2, where you have made a deal of 50 lakh rupees of that particular house only, but now there is some bad news regarding that particular area, or something which is not that good for say property property dealing industry and all. So what happened is, now the value went down from 50 lakh to 45 lakhs, straight away 5 lakh rupees lost to you, because you have made a deal at 50 lakh rupees, you have given the token money, and now the value has dropped down and it has reached to 45 lakh rupees only. You are making a loss of 5 lakh rupees. But this is where options come into play. In our situation 1, you were making unlimited profits, but in our situation 2, you will make a limited profit, a loss. What is your limited loss? The amount of premium that you have given to your builder or to your broker. Say you had given him 50,000 rupees. Now this token money will not be refunded to you at any cost, whether you or like honor your whatever commitment you have made, or you cancel the order. That 50,000 will not be refunded to you. So I would like to ask you all, a 5 lakh rupees loss or a 50,000 rupees loss, what will you choose? Guys, please reply.
Sir, it's better to have a minimal loss.
Exactly. And this is where options come into play. You will lose 50,000 rupees only, and you won't buy that particular household. Okay, sorry, household, not household, that particular house. This is what I have told you. You have full right to buy, but you are not obligated. So it is not like if you have given the token money, you will have to purchase it at any cost. If you are making a loss, better you like lose your premium amount and exit that particular trade. Okay, so this is the power of options. Whereas in futures, you were required to maintain a certain balance of premium in your account at every time, else your position would have been squared off by your broker only after giving you certain warnings. So in futures, you are making unlimited profits and unlimited losses. Whereas in options trading, you are making unlimited profits with a limited loss. Are you all clear with this? And are you all with me till now?
Yes, sir.
Yes, sir.
So,
Okay, perfect. So we are clear with call option. We are clear with put option. Now we will move on to some very important terminologies. Uh, See, here the terminologies are very much similar to what we have already discussed in a session of futures trading, also basics of futures. So again, we will like I will tell you all. It will be more of a kind of revision for those who attended our basics of futures session, and for those who didn't attend because of any reason and are here now, they will be able to understand these terms in a better way. See, the first term which we will discuss today is strike price. Strike price is nothing else but the predetermined price at which a buyer has a right to sell or buy that instrument. The strike price is mentioned in the name of option along with the expiry date. Whenever you will buy or try to buy, say, ITC options or Nifty option, you will be given the strike price as well as the expiry of that particular option. For expiry, we know that there are three terms like near month, far month, and near month, next month, and far month. So your expiry will be according to that only. Now, in our case, like what we discussed, as an example, what could have been the strike price? It was 50 lakh rupees, the amount at which me and the builder or my broker agreed that yes, this is the price at which this particular trade will happen. So this is known as a strike price. Okay. Similarly, we discussed about spot price in our basic of futures session. Spot price is nothing but the actual price of that particular stock in the stock market. Say, if you are going to buy Reliance future, then the value, like the stock value of Reliance in stock market, will be known as the spot price. Okay, and Reliance future is different from Reliance stock. Reliance future is more of a kind of contract, whereas Reliance normal stock is nothing but like equity share only. So there is a subtle difference between future like contracts and the original equity market or cash market. So we have to keep that in mind. Expiry of contract, we have already discussed many a times. Options contract has a stipulated time period. Every contract expires on the last Thursday of every month. Okay, and I have already told you that Bank Nifty and Nifty contracts expires every week as well. This is because of which you will find a very high volatility in bank Nifty or say bank stocks on every Thursday. Okay, if the last Thursday of that particular month is a holiday, then expiry falls on the preceding day, that is the last Wednesday of that particular month. We have already talked about near month, next month, and far month. The near month, for like, let's take an example to make it clear more. Say if you have entered into an options contract, I'd say in July, in month of July. So now in your case, July will be your near month, August will be your next month, and September will be your far month. Now let's suppose this July contract will end on 29th of July. So the next contract that will be available for you is of August, September, and October. So now in this case, August will be your near month, September will be your next month, and October will be your far month. The same thing happens every time. If a particular contract expires, the next month becomes the near month, and so on the situations prevail. Okay, so now talking about our next term, which is contract value. Before talking about uh, okay, so let's first talk about contract value only. Contract value is the value that is arrived by multiplying the strike price and the lot size. We all know this thing, that while you are trading in derivatives market, there is certain you can't buy a particular stock in like in whatever quantity you want. There is a fixed lot size into which only, like in which or in multiple of which only you can buy a contract. So what actually a contract value is, it is nothing but the strike price multiplied by lot size. Say if like we have already told you this, Nifty, the lot size of Nifty is 75. So in order to buy Nifty, you have to buy 75 Nifty, and this is the lot size. If you want to buy 80 Nifties, it is not possible. You can buy only 75, 150, 225, or so on, like in multiples of 75. Okay, so whatever your strike price is, when you will multiply that with the lot size, then you will get to know what is the contract value. For lot size, we have already recently only we discussed. Each and every stock has its own lot size. It is decided by the market, or more specifically by the stock exchanges, that what should be the lot size or the size of that particular stock. So this is what we call as a lot size. In equity market, there is basically no lot size. You one share is termed as a lot size, and you can buy in multiples of one. Like in you can buy any quantity, 2, 3, 4, 5, 100, 200, 500, any quantity, but you can't buy 2.5 shares of Reliance. Why? Because there the lot size is one. Over here, like in derivatives market, let it be futures, forwards, options, anything, the lot size is predetermined by the stock exchange. Now we'll talk about options premium. This is the, like, the actual loss that we can incur in that particular contract. Okay, so what actually option premium is? Options premium is the price paid to acquire the option. In our case, 50,000 was the token amount which we gave to our broker or to our builder, so that we can buy that particular house. So in our situation, 50,000 was the options premium. It consists of two components. The first one is intrinsic value. The second one is time value. Again, something which we have already discussed in our basics of futures session, but I'll cover it up in a very simple manner. Intrinsic value is nothing but the amount by which the option is in the money. whatever amount you are paying off. Like while we discussed about futures, this value, we discussed about this value, like we discussed that if you will go and look, there will be a difference between the spot price and the future contract price, and that difference between the spot price, or we can say the actual market price of the particular stock, and the future contract price is known as intrinsic value. Time value is something which we, like, everyone know. The time value of an option is the difference between its premium and its intrinsic value. Over the market and at the market options will have only time value because intrinsic. So this is something which we'll discuss in a few moments. In order to understand that intrinsic value and time value, it is really important to know what actually the moneyness of options is. So for that, there is like three things. Okay, in the market call, at the market, at the money call, and out of the money call. Same thing we discussed in futures basics. There was something, if you, like, if your spot price was higher than the future contract price, we used to tell it that we are getting that at a particular discount. Whereas if the spot price was equal to futures price, we termed it as at par situation. And in the case where the spot price was less than the future contract price, it was termed as at premium situation. Okay, so the same thing is over here in options trading. The only difference is the terms that we use in options. When the spot price is higher than the strike price, it is known as the in the money call. A put option is said to be in the money call when spot price is lower than the strike price. For a better understanding, I will take an example for you all. Say Nifty spot price is 12,000 points. Okay, and you are, like, say, bullish about Nifty. So in case this strike price is just 11,800 or 11,900, this is something which we call as in the money call, because over here the spot price is less than is higher than the strike price. Similarly, if say Nifty spot price is 12,000 points, you are getting an options call option at the strike price of 12,000 rupees. It is known as the at the money call, which means simply you are getting this call at a par situation. If the, like, say, the spot price, which is 12,000 points, is less than the strike price, which is 12,100 points, in this case it will be known as the over the money call. And in futures trading we call this as a situation of premium. So at a premium situation. Similarly, if you feel that Nifty can go down, you have a bearish overview of Nifty, then for you this situation will be known as the over the money call. 12,000 will remain as the at the money call, and this 12,100 or 12,200 points will be known as in the money call. So there is a vice versa, or like vice versa situation if you are in call or in your put. So for a person who has a bearish overview about a particular stock or about a particular index, the in the money call for a call option is equal to out the money call for a put option, or the in the money call for an put option is equal to out on the money call for a call option. Now you will get to know this thing very better, in a much better way. In the money call is when the spot price is higher than the strike price. A put option is said to be in the money when spot price is lower than the strike price. Spot price is lower than the strike price. Similarly, over here, when the spot price is higher than the strike price, you have a bullish overview. This will be known as a in the money situation. If the strike price is equal to the spot price, it is known as at the money situation. And when the spot price is lower than the strike price and you have a bullish overview, then it will be known as out of the money call option. And if you have taken a put option and the spot price is higher than the strike price, in our case 12,000 is higher than 11,900 or 11,800, it will be termed as on the money call. I hope you all are getting me.
Yes, sir.
Okay, so that's really great. I hope I made things pretty much easier for you all to understand. Now we will talk about the advantages of trading in options. Like in our previous session, we talked about advantages of trading in futures. Now, what are the advantages, or why should you actually go for options rather than going for futures contract? See, you will get a favorable risk reward ratio. How can I tell this? Whatever the premium amount you are paying is the maximum amount of loss that you can incur. Whereas if the particular thing or particular stock goes as per your understanding, there is a chance of making unlimited profits at the same time. Whereas if we talk about futures contract, you have, like, you are on the verge of making unlimited profits, but at the cost of making unlimited loss. So there is somewhat, we can say, a 50-50 proportion or 50-50 probability of making money or losing money in futures contract. But in this situation, your premium amount will be the maximum loss that you will incur, and a huge amount of profit is waiting for you. What we discussed in our example of house, we were losing 50,000 rupees if the price went from 50 lakh to 45,000 rupees. Whereas when the price went from 50 lakh rupees to 65 lakh rupees, we were making a profit of 15 lakh rupees. You can assume like what can be your profit percentage if you are making a profit of 15 lakh rupees and you're risking just 50,000 rupees for that. The second benefit is low margin is required. We already discussed that in stock market or in cash market, you require 100% of your money to be invested. In futures, it was very less. In the example we discussed, it was just around 18% or it varies from a broker to broker, from script to script. So this is something like 100% and now 18% in futures. But in options, it is pretty much lower than that also. For that, we have an example for you all. Let's suppose that we are in cash market now and we want to purchase ABCD Limited 4,000 units. Okay, the current price is 400 rupees. So in order to buy 4,000 units, we would require 4 lakh rupees. Since we are trading in cash market, we don't have any margin money, so we have to buy that particular stock at say 4 lakh rupees by investing 4 lakh rupees at the very moment. Let's suppose this value or the prices of that particular stock went from 100 to 110. So you made a profit of 10 rupees at 4,000 shares. So in short, you made a return of like a profit of 40,000 rupees. 10 rupees multiplied by 4,000 will give you 40,000 rupees. And if you will compare your returns, you invested 4 lakh rupees and you gained 40,000 rupees over that. So not approximately, exactly 10% of return. In this, I have not included the brokerages and various taxes that are levied, just for the sake of simplicity. Now, let's suppose we are in futures market now. We want to buy ABCD Limited shares only. We have to buy like 4,000 units or quantity at 100 rupees. Your value of contract will be 4 lakh rupees, but the margin required by you for that particular amount is, as per our example, of 18%. If you will calculate 18% of 4 lakh rupees, you will get 72,000 rupees. What do I mean by this is, in order to buy 4,000 units of ABCD Limited at 100 rupees, you just need to pay 72,000 rupees, not 4 lakh rupees. But your value of contract value will remain as 4 lakh only. And let's suppose we sold it at a price of 110. We made a profit of 10 rupees at 4,000 shares, so our profit is 40,000. Now what will be my return? I will simply divide 40,000 by 72,000 and multiply it by 100. It will give me a return of 55.5% return. they we are buying the same quantity at same price, but see the difference in returns. And now we will take an example of options market, option derivative, option contract. We want to buy ABCD Limited share 4,000 units, and now your rate is, say, there is a mistake over here, it is 100. Okay, so you have to okay, no, in options market you will get this as your rate of 5,000, sorry, 5. Just give me a moment, please. Yeah, okay. So there is a mistake over here. We will take the rate as 100 only. So in order to buy options contract, or say we are bullish about this particular ABCD Limited, so we want to buy 4,000 quantity. It is about like something which is equivalent to the lot size only. So we want to buy 4,000 units at 100 rupees. Our investment will be 4 lakh rupees. Now, in our example of options market, we need to pay just an margin money or token money of 5%. So 5% of 4 lakh. We will take 5% of this 4 lakh. This will be equal to 20,000 rupees. Okay, and let's suppose we sold it at a price of 110 rupees. We made a profit of this 10%, okay, 10 rupees on our investment of 20,000 rupees. Okay, so sorry, 10 rupees profit on 4,000 shares. So it will be around 4, yeah, again 40,000 profit will be over here, same, but our percentage will change now. Why? Because we invested only 20,000 rupees and we have earned a return of 40,000 rupees. So, short, your money doubled. And this is why we have written that you have gained a very decent return of 100% because your money increased. It got doubled only. Okay. So, this is another benefit of trading in options market. You will get some sort of protection against market volatility. Why? Because owners of stock or equity portfolios can hedge their portfolio by purchasing put options of indices or individual stocks to protect the portfolio till certain uncertain from uncertain falls. Okay, so what do I actually mean from it? If suppose you have purchased a particular stock, okay, and you're not very sure about it whether it will go up or it will go down. So what one thing you can do is you had a bullish overview about that stock, so you purchased that stock in cash market, but now you are very uncertain. So what you can do is, since the premium amount is very less in options trading, you can buy a put option of that stock only. So in case if that stock falls down, you will make money in options market, and if it goes up, then you will lose just premium amount and you will gain returns from cash market. So this is something which options market help you out, like options contract help you. It helps you to overcome the market volatility. Since the premium amount is very less, as we have already told, like discussed, here our premium amount was just 20,000 rupees. We were playing a game of 4 lakh rupees with just 20,000 rupees. So this is something which we can easily do, and if the price goes down, we will make money in this market, and if it goes up, then we will just lose 20,000 rupees, but we will earn good returns in our cash market. So this is something which you can also try, but keeping in mind the risk capacity, risk taking capacity, risk appetite of you in about that particular market. Also, just because we all are beginners in the market, uh, just learning new things about the market, it is certainly not prescribed to people to go for derivatives market straight away, because these things seems to be very easy, but once people start doing all these things, they make losses. They certainly fail because of their lack of awareness about market, lack of experience in the market, and then people blame that stock market is a gamble. So in order to be a very good and a successful trader in any sort of place, like whether it is derivative market or cash market, you need to have a very good amount of experience. Higher percentage gains is something, another example, another benefit of options, because if you'll see in this example, with the same amount, with the same script, same quantity, same rate, we were getting different returns. on our investment. And if you see, options trading, options market, options call, anything is giving us the maximum return as compared to these other two. And there is no mark to market, like you don't need to maintain additional uh, money or additional thing in your P&L, or sorry, not P&L, in your trading account. We talked about this mark to market in our futures basic, and the same thing is not required in options market. So in, if you were trading in futures, you were making losses, then you have to maintain a certain amount in your account. So that was something which we call as mark to market. Every day your profit or loss for that particular day was calculated, and the amount was transferred from your trading account, or it was transferred to your trading account as per the situation. Okay, so in this you don't have to maintain any sort of thing, because it is just a game. It is just a game of premium amount that you have already paid. I hope I am pretty much clear. And if someone wants me to like clarify more thing, the house is open for you all. This is what we had for you all for this session on options trading or basics of options. Okay, so are you all with me till now?
Yes, sir.
Yes, sir.
Okay, so that's great. Like, if you have any sort of queries, you all can ask me. Um, yeah.